So where are we headed? What's going to happen in the future? This is where we get interesting. So we're in the mid to late stages of business cycle. And what does that mean? That means, growth might be peaking. It's never really took off, right? So it's tough to tell that. I'd say growth is moderating, but it's been moderating for 8 years. It's in between there. Credit growth is still strong. We're not tightening. We're tightening on the federal level. The Fed is, but individual banks are not really tightening. They've been tight. They're sort of loosening, actually. Profit growth, I don't see a peak. I see it continuing. And we'll see more about that in a second. Our expectations of 2017 as a year and 2018 as a year are more and more positive. Policy is neutral here. It's contractionary here. We're getting towards contractionary. The market's starting to recognize that. And we saw earlier inventories and sales were declining. Remember that slide on GDP where the parts of GDP and inventories were down? That flip-flops. We build a bunch of stuff and put it in the warehouse, and then we sell some of that stuff off, and then we got to build more stuff. And so inventories kind of ebb and flow. And the last quarter, that inventories were negative. Okay. We just want to look at expectation for global growth. It's not a huge number. We're talking 3%, but 17, 18, 19, we're talking 3% growth looking forward. And it's different areas of the world. We got lots more growth in Asia, East Asia, Pacific, South Asia, lots less growth in Latin America and Europe and Central. There's different places, but all in, we're looking at pretty solid growth. And that's what the expectations are on the street. And there's really no reason. Companies are doing well. We're doing well as consumers. There's a lot of talk about inequality here, and that's real. But as a global set of consumers, there's way more people rising up elsewhere than are having challenges here. Globally, the economy is incredibly powerful. This is what I was talking about a second ago. So the red is, they're both kind of red. What do you guys see? Red and orange? Red and orange, okay. So the left one, the red one is 2017, total year estimate. 2018 is in the orange on the right. Notice, positive, 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 positive. This is expectations except for materials and energy. But what is materials and energy? What part of that why is it negative going into 2018? The question is, why was it positive going into 2017? Oil. So in 2015, 16, oil goes down in value. All these oil companies have a difficult time. There's no earnings. So that's why you see this huge pop in energy. And for other reasons, oil is used as a material for other things. So that's why you get a positive, you get a negative for 2018 relative to 17, because 17 relative to 16 was so positive. So an expectation of future earnings growth, starting from revenue, which is a great thing. Okay, so Russell says, our global team of investment strategists warned that investor expectations have run ahead of market fundamentals, right? So we're talking about the US. In the US, we're at that 22 or 26 or 29, whatever, the valuations are stretched. And since the end of June, they've become more stretched. So the value isn't in the US market right now. That doesn't mean we should run from the US market. It just means we're not buying cheap things anymore. There are no cheap things, okay? So this guy, John Hussman, actually talks about this 57 to 62% decline to get back to normal market valuations. What does he mean there? Remember the CAPE? We talked about memorizing the 29.82 versus the 16.5. If you take 29.82 and drop it down to 16.5, you're resolving the PE ratio by reducing the P, right? Right? If you have a ratio of price versus earnings, and it's a really high number, there's two ways you can reduce the ratio, right? First way is reduce the P. Second way is to increase the E. Everyone got that from math? Okay. So that's all he's saying. He's saying, I think that the way this resolves is we have a huge price correction. He has been saying that every day since 2008. So after everything fell apart, he still said this. And I'm gonna actually quote this guy. So this guy is, do you guys know who Jim Rogers is? He's on CNBC literally all the time, like almost daily. And Jim Rogers says, this is just a series of headlines, and he's called a legendary investor because he was right once. So now now they quote him all the time, literally. So he's in 2011, here's the headline, 100% chance of crisis, worse than 2008, Jim Rogers. 2012, Jim Rogers, It's going to get really, really bad after the next election, right? This is after Obama gets elected the second time. 2013, Jim Rogers warns, you better run for the hills. 14, Jim Rogers, again, sell everything and run for your lives. 2015, Jim Rogers, we're overdue for a stock market correction. 2016, and this is my personal favorite, 68 trillion biblical crash dead ahead. Jim Rogers issues a dire warning. 2017, the bottom line. Legendary investor Jim Rogers expects the worst crash of a lifetime. So if you read Yahoo News or watch CNBC, this is the kind of crap that's there all the time. And he's been wrong. He will eventually be right. And then he will be a genius and he'll be revered and right. Eventually, a broken clock is right 2 times a day. And that's what this is. That's what he is. Now, I sort of think this is going to happen. And this is Jeremy Grantham, founder of GMO. This man is smart. Everyone doesn't give him credit for everyone calls him a bear. I don't think he's a bear. I think he's smart. And what he says is our return expectations going forward should be muted. And the reason is we might see some price decline, but what we're not going to see is big price increases, but earnings are going to continue to increase. We're going to resolve the PE ratio. Rather than dropping the P, we're going to raise the E. It's going to take 20 years. So when you look at his, he does these charts once a month, and one of the charts is you can expect in U.S. equities, in large cap U.S. equities, you should expect a 10-year return of about 2%. 1.5% is dividends. So 0.5% of actual price return, large cap U.S. companies. So let's talk about large cap U.S. companies. What is the single fastest growing investment in the United States right now? Where's everyone putting their money?
Real estate.
No. S&P 500. There are, when someone's, I'm going to invest in stocks. I'm going to invest in stocks. I don't know what I'm going to buy. I don't trust mutual fund managers. Those guys are trying to rip me off. I want to buy an index. Which index should I buy? S&P. That's on every, right? That's on every station. Everyone quotes S&P 500. I'm going to buy the S&P 500. So there are 400 mutual funds that do the S&P 500. There are at least 30 ETFs that do the S&P 500, more than that probably, and they slice it and dice it in different ways, but it's all 500 companies. If you invest in those 500 companies, you have a higher PE ratio than if you invest in the next 500, just by virtue of the volume of people chasing that. Is it going to collapse? That's not what I'm saying. I don't know what's going to happen. It's just an interesting thing to see that the thing that gets the most publicity, people chase. And if you're investing in the S&P 500 fund on the side, it's a buyer beware sort of thing. I think that that's where you see a lot of this retrench. I do think we see a decline in returns going forward, and I do think we see an increase in volatility. So as we see that volatility, we'll be more scared because of our decline in expected returns. Why would I take a 20, 30% volatility if I'm only going to get a 3% return? That doesn't make any sense. That's not a good trade-off to make, right? So we're going to talk about what do we do instead in a second. We're going to watch a couple of things throughout the next, the short period of time. Obviously, we're going to watch this protectionism risk that we have. We're going to watch whatever Trump does. Like we're going to, just because it's a comedy show as well as just being something we should pay attention to. Brexit and the like, not a lot of risk to us there. Our economy is going to be fine. Brexit's going to have a hard go. What we've seen is we've seen the European Union make a pretty hard line on negotiating. There's not going to be an easy out for you. You have to actually take your lumps. Like if you're going to leave, you're taking your lumps. We're not going to soften this blow for you. So there's banking risk, China, Turkey, there's a lot. There's a question of the value of the balance sheets of the banks in the emerging markets. And that's a real question. And that's a question of we don't even know what they really are worth. Okay. We're going to watch consumer sentiment. We already talked about that. As long as we're feeling good, we're going to spend, we're going to invest, we're going to start businesses. If we start not feeling good, that'll be something that will tell us that something else is coming down the pipe. But there's a reason to be nervous if we're not feeling good. Okay. Investor sentiment. So that was consumer sentiment. This is investor sentiment. So everyone knows this quote. I'm going to read it anyways. Bull markets are born on pessimism, grown on skepticism, mature on optimism, and they die on euphoria. The time of maximum pessimism is the best time to buy. The time of maximum optimism is the best time to sell. Sir John Templeton. So this is investor sentiment. there is no optimism or pessimism that's weighing in right now. That's a good sign. Companies are going to argue their way and figure it out. They have to produce. No one's going to give them a free ride. We're not just going to invest in them and not watch it. This is a good sign. There's no optimism, no real pessimism. And then this is the one that's the big question. This is how will the Fed unwind this balance sheet expansion? So this is about, and it's kind of jagged and kind of bumpy, but this is about $600 billion added to Fed Reserve's balance sheet every year since 2009 till now. And it kind of flattened out in 2014-15, and it's been flat ever since. And they've come out and they've announced what they're going to do about this. And what they're going to do is they're going to take, starting with $20 billion a month, they're going to go 20 billion, they're going to see what the market does with that. They're going to go to 30 billion, 40 billion, see what the market does with that. They're going to go to 50 billion. And they're just going to unwind the balance sheet until, at the 50 billion mark, until they're done. So
What do you mean, like they take 20 billion? What do they do with it?
they can sell it back to the market. They can let it mature. They can not refinance it. They're basically going to be pulling money out of the market. They put the money in, they're going to pull the money out. So it's interesting that $50 billion a month is $600 billion a year. So they did it $600 billion a year, and once they get it, they're going to do $600 billion a year down. They're normalizing. They're normalizing. So why are they doing that at the same time they're raising rates, while, as Neil Kashkari says, the data doesn't support that? Why would they do it? Inflation and employment, right? They keep inflation low, they keep employment at the maximum, right? So those two things, employment's at we're kind of full employed, and inflation's non-existent. So why are they raising rates? The last two times they went to zero or low on rates, asset bubbles formed. Asset bubbles are not inflation. They do affect employment, but they're trying to avoid or be prepared for the next asset bubble. And when they normalize their balance sheet and they raise rates, they will be prepared for the next asset bubble. In fact, by doing that, they may reduce the possibility of that asset bubble forming. So they, like .com is an asset bubble. Real estate was an asset bubble. They pop, bubbles that pop.
So they're letting water out of the dam, anticipating that there's going to be
Exactly.
a big runoff in the fall.
Not really anticipating. I think Janet Yellen is really smart, and she sees, right, she's just saying, okay, before we get there, let's start normalizing. Even though what Neil Kashkari said is right, the data is not 100% in Janet Yellen's favor. She said all along, this will be very data dependent how we do this. We're gonna make a move, and then we're gonna sit back and look. We're gonna make another move. We're gonna sit back and look. And so she's still doing that. The announcement was a move. This is what we're gonna do.
What the data's telling her is that now's the time to take some kind of action rather than be inactive.
Right. She has to do something. Right. And I think she's right on. And I think she has actually. My big fear is that he decides to appoint somebody else next year, because he could choose somebody else, and I think that's a mistake. I think she's got a pretty good handle on it.